For joining us this morning from wherever you are. My name is Lena Dobrier. I'm the Director of Operations at Opus Connect. We have done a number of these webinars at this point. We're a lower middle market M&A focused organization, membership-based, catering to private equity firms, investment bankers, lenders, independent sponsors, really the transactional folks in lower middle and middle market M&A. We're doing a number of events throughout the year. I think we did close to 350 last year, and similarly this year. Obviously a mix of virtual and in-person webinars like these, Deal Connect, like many of you are participating in afterwards, where we're pairing up capital providers and investment bankers for one-on-one meetings. So lots going on in terms of business development and cultivating community within this space. If you're interested in learning a bit more about who we are, how we can help, please reach out to myself or any one of my colleagues. Swayze Yancey, his contact information is below. We'll be happy to answer any questions that you may have. Today, you all will participate via written Q&A. So as questions come up throughout the discussion, please submit those in the Q&A bubble at the bottom of your screen. I will ask that you refrain from using the chat function, please, and specifically submit your questions in the Q&A bubble. That will be best for us to keep track of, and we will try to get to as many as possible. I have a question before we begin. We want to know who you are. I'm gonna go ahead and launch this question here. So you'll see a bubble pop up. Just let us know who's in the room. I know just have a few on here so far, but at least this will give our panelists an idea of who they're speaking to. So go ahead and submit your answers and I will read them off once complete. I'll give it about 10 seconds or so and then we'll move forward. Great. So 33% capital providers on the equity side, 22% independent sponsors, 22% investment bankers, and 22% service provider. Thank you guys for participating in that. I want to give a shout out to Plante Moran, who is the sponsor of this event. They have been doing a number of events with us. Schafer of Plante Moran is going to be leading today's discussion. So I'm going to kick it over to him. He's got 20 plus years experience in this field, specifically in healthcare services. He's the partner of healthcare services at Plante Moran. And so he's going to guide us through today's discussion. So without further ado, Schafer, take it away.
Thank you, Lena. I appreciate the introduction there. Quick background on myself. So Chad Schafer, as Lena mentioned, I've been with Plante Moran for just over 22 years, partner in our for-profit healthcare practice, focusing mainly on physician and healthcare services, specifically do have some manufacturers and distributors who are paid with Medicare and Medicaid. And that's really kind of my spot that I focus on within the firm. Also do some consultative services as well when it comes to transaction financial projections, but you're likely here not to listen to me. So I will move on to the featured panelists that we have today. I'll let them introduce themselves as we work through. I'll start out with Jonathan Bluth from Brown Gibbons Langan Company.
Well, thanks, Chad. It's nice to speak with everyone this morning. Jonathan Bluth, based out of Los Angeles, recently joined Brown Gibbons Lang. We have 100 investment bankers that cover a variety of different industries, 21 healthcare-focused bankers. I'm one of their 6 MDs. We advise companies all across the healthcare spectrum, provider groups, diagnostics, labs, device, therapeutics. We cover the industry with a lot of breadth and depth, with something approximately 20 engaged clients right now. There are various stages of marketing, and so looking forward to sharing with each of you some information about what we're seeing in the market. I've spent my whole career in healthcare, 20 plus years, advising companies at various stages of their life cycles, and looking forward to sharing some of those perspectives.
Thank you. Moving on to Vladimir.
Thanks, Chad. Happy to be here again, reconnecting with some old friends and meeting some new. Vladimir Andonov, I head up business development at Martis Capital. We're a low middle market private equity firm focused on healthcare. I've been around since 2011 and currently investing out of our 4th fund, across mostly services, healthcare, IT, and some consumer and products. We do both control and minority investments. And yeah, look forward to the one-on-ones later today, and yeah, look forward to a good conversation. Thanks for having me.
Thank you. Dan?
Thanks, Chad. My name is Dan Schultz, and I lead business development efforts at Webster Equity Partners. We just recently closed our fifth fund, which is 1.7 billion, and we're exclusively investing in healthcare services. So we're looking forward to a good conversation today.
All right. Well, thanks, everyone. Appreciate the panel taking the time. So we're going to talk a little bit today about obviously what's going on in healthcare M&A and really get an understanding of the impact of the current inflation and rising interest rates and what that's having on not only deal flow potentially, but also on how folks are viewing potential acquisitions and add-ons as we start the conversation. So hopefully nothing too controversial, but we're certainly open to have a good conversation amongst you three. So thank you. So just want to kind of set the stage. So if we step back a year ago, there was a significant amount of deal flow starting in the third quarter of 2021. How would you see that so far year to date in 2022 and kind of looking out into the next 4.5 months now? Vladimir, I'll start with you.
Sure. I'd say, as we know, private markets really lag the public markets in terms of valuations, which we'll talk about. But in terms of volume, I think it's still pretty good deal flow. I think the expectation is this year will be probably a little lighter than 21, which was a record year by historical standards. So nothing to take away from a still robust M&A environment, as I'm sure Jonathan and Dan agree. But I think benchmarking of 21 is always going to be a hard one, given how much activity there was. So we'll get into the details, but I think we see still very robust deal flow in services. Dan obviously spends a lot of time there. On the IT side, I think that's where you may see a little bit of variability versus 12 months ago, largely because those valuations perhaps have seen a little bit of a dent, again, versus services, and sellers and buyers maybe having different views of what the business should be worth. So in all, I'd say still a strong 22, probably a little lighter than 21, but a lot of quality deals out there and a lot of private equity and strategic capital pursuing those deals. Curious about the other views here.
Yeah, I'll jump in on that one too. So I think we saw 2022 start off a little lighter than 2021 in the first couple of months. March, April, and May were very strong, and then June, July, and August were pretty level, at least year to date in August, with what we saw in 2022. Seems like there's a little bit of a slowdown now in the last couple of weeks of August, with the expectation that post Labor Day, there's going to be a bunch of deals that are going to be coming out. And I think that's sort of consistent with what we saw pre-COVID and people taking some time off. But there's not the urgency right now to get a lot of deals done. So I think deals are coming out in more of a scheduled manner rather than just let's get it out as soon as we possibly can.
I'd agree with Vlad and Dan. I think we're seeing volumes consistent with what we have over the last 12 and 24 months. Maybe not as high, as strong as 2021, but still very strong. We have not seen a material change. If we think about the title of our panel, we haven't seen a material change in interest or pace of activity since changes to the interest rates were announced. And I think, Dan, you're bringing up a really good point. We are seeing that several of our clients and prospects are putting conversations on hold to take a meaningful vacation. I think that that is a positive change, I think, for all of American society, that people are choosing to prioritize a little bit of family time and a break. But aside from people saying, hey, can we put this on pause for 2 or 3 weeks while we take some summer vacation, we're not seeing a major overall change in the long-term levels of interest and the quality of companies.
So with that delay, I know that some of it can be attributed to vacation. Is there more scrutiny being put on individual deals from a buy side perspective that you're seeing, or certain aspects that you're looking at differently than you would have looked at a year ago?
Maybe I could jump in with one idea here, and I'm curious, Dan, I'm glad to hear your thoughts on this too. But I think about a year or two ago, we started to see some bankers representing companies with very aggressive, very bold forecasts, maybe even unrealistic forecasts. The concept of maturity adjustments, and I think that some people have had gotten used to getting credit for aspirational growth that maybe they couldn't necessarily prove. And so I do think that we are seeing a little bit more scrutiny on financial models, a little bit more scrutiny to make sure that companies can prove that they have already started to demonstrate some of this performance. They can't just get credit for something that they hope to achieve. But companies that have good business models, that have demonstrated success, are getting, we'll dive into a little bit more about valuations a little bit later, but the companies that can demonstrate a viable growth trajectory can still withstand that diligence, but there is certainly much more diligence behind numbers from acquirers than maybe we've seen in the last few years.
Yeah, Jonathan, I think you're right there. I think the other thing that we've seen a lot more is this COVID adjustment to EBITDA. So now, to sort of realign EBITDA to prior years and in future years is this COVID adjustment, which, there's always some conversation about it. There's always more diligence around what does this number really mean? How is it consistent? Is it consistent, et cetera? So I think you're having more of those conversations, but I'll say good quality deals, firms like ours and firms like Vladimir's, we're looking for those all the time. So valuations aren't really coming down to adjust for that, but there might just be a little bit more due diligence from our third-party providers as well as what banks are asking us for.
Yeah, I agree. I'd say we would look at it perhaps from, say, Jonathan bringing a deal to us and looking at that, but we actually also exploring exiting some of the assets in our portfolio, and right now a couple being in market and are seeing it real time with these first round bids and maybe second round bids coming in, and how buyers are, to Jonathan's point, more scrutinizing our projections. Maybe 6 months ago it was going to be a bit more sort of, let's take it sort of as you presented it and underwrite that. It's just nothing that you would not expect in a market that's maybe a little bit more conservative, just for the future. With healthcare, which is all we're talking about today, we're fortunate that it's a resilient sector, and so the outlook is, I think, generally positive. And the latest readings I've been doing on the macro overall is that even if we do have a recession, it's probably a softer landing versus an abrupt recession. The Fed's obviously stepping in. We'll look to manage it to that. But what I was going to add as well was, in addition to scrutinizing financials, forecasts, and EBITDA, the other thing we're seeing a bit more now, and would love to hear from Jonathan and you, Chad, is a structure, introducing some structure to the transactions that maybe provide a little bit of either preference on the sort of liquidation side or any downside protection that maybe, again, until recently you're just participating purely in the equity upside, and now people are a little bit more concerned about what happens if we miss the forecast, or it's a longer hold. Do we have any protections? So I think we're starting to see a little bit more of structure introduced in sell side processes, but love to hear from others.
It's an interesting point. I guess I haven't seen that there is a major shift in just broad application of structure, but consistently when there are companies who struggle to prove their growth strategy or prove that they can retain their volume, when there's uncertainty in a business model, I do see that there are multiple bidders in those kinds of processes that deploy that structure. And depending on the quality of the asset, depending on how much influence and leverage a potential seller can have, determines whether or not they have to accept that protection for a potential investor. I mean, I think it's a really important tool to protect downside risk for an investor when there isn't clarity, when a seller can't provide assurance about their outlook. And we do see it's more, I guess I see it more situational, that it's applied based on the caliber of the company or the company's particular situation, as opposed to wholesale. We're not seeing structure on all of our deals. I think it's certain deals, it sometimes comes up depending on their situation. And Chad, curious to hear your thoughts on that too.
Yeah, I mean, so I think at the end of 2021 and into 2022, what we started to see, especially from the audit side, as we're looking at these transactions and deals, is you saw some more unique and unusual contingent consideration at larger numbers, really with some significant upside. Normally it would be EBITDA based, but a lot more on volume and being able to maintain certain contracts because going back to your point on having some COVID adjustments, if your COVID volume was tempered because of COVID and you say you're going to get more once you get out of COVID, you're going to increase, then you kind of attach that to additional amounts for the seller. And that's where we saw probably a few unique things over the past 6 months on transactions that we hadn't seen historically. Most things were pretty straight EBITDA targets or opening certain, in the urgent care setting, opening clinics, but we saw a switch to some volume metrics that were different than what we'd seen in the past. Anything on that, Dan, as well, or?
No, I think that's consistent with what we've seen as well.
Okay. So I know we talked a little bit about, and Vladimir, you brought up the resiliency of healthcare. Is that a broad statement, or are there certain, whether it be practice management, healthcare services, are there parts of it that are more resilient than other, you think, when it comes to being able to, temper back on some inflationary factors?
Yeah, I can kick it off and love to hear from the others. We focus across a broader area of healthcare than perhaps Dan and his team, but in services, I mean, it comes down to people. So you got to really manage labor costs. Those have been going up. I was just reading on the way in today an article that more people have been coming back to healthcare, in particular sort of nurses and other sort of home health sector employees, where one of the reasons is Amazon and others are obviously letting some people go, but also it turns out healthcare is paying quite nicely. And so you see that during downturns where people do flow back into healthcare. So that demand or supply, I guess, of labor probably should keep rises in sort of wages in some check, and they're still going up. In fact, the article was quoting that they've been higher than some other sectors. So, and ultimately there's a supply demand balance that has to happen. But I'd say in services, that's a big variable that really dictates how certain industries or subsectors manage inflationary sort of pressures. If it's sort of a heavily government reimbursed space versus more private pay, sort of the ability to pass through some of those labor increases is obviously can vary. And I think we discussed last week when we got together that we have a business in our portfolio that provides unskilled home care, called community-based care, CBC, where it's in multiple states, so different state dynamics as well, but it's ultimately a Medicaid business. And it's a pretty thin margin sort of within a certain band where if your cost structure gets out of whack, you could see yourself getting in a tight spot. But government is actually smarter than we often give it credit for. So you will see over the medium to long run, if not immediate, that there's adjustments in the rates where they know that these are costs of care settings where the cost is pretty low and you don't want to drive providers out of business. So it's probably a longer answer to your question, Chad, but I'd say in a more holistic view of services, you'd expect them to be pretty resilient, just because, especially those that are in a lower cost setting overall, where reimbursement is positioning those providers to really remain, kind of in operation. I think on the IT side, and I know maybe Dan has less perspective there, but that's where you probably would see some challenges around managing more of a virtual workforce, right? People don't have to come in as much to do their, software and other sort of technology development, but we haven't necessarily seen pressures there in our businesses. So I'd love to hear from Dan on some of the physician practices. I think you guys probably have a bit more exposure there.
Yeah, I mean, as far as inflation, I think you're exactly right in some of the low end home health hospice. We saw about a year ago, and I think there's a question that was asked to us about, supply of human capital. A year ago, it was very, very hard to hire and keep and retain people. Part of it was the burnout of COVID. The other part was you have larger corporations that were paying $25 an hour in some markets, which was a lot more than what we were able to pay. Now the market is very, very strong for healthcare in terms of human capital. We're able to fill roles. There's a supply of qualified people, and that's been great. Inflation hasn't had as much of an impact on us just because we're all services based. And so in the physician space, we've got a broad variety of portfolio companies from retina to fertility. Some of those services people still are getting them. If there's a couple looking to have a baby and they need fertility services, it's not going to matter that inflation is up in terms of what they want from that. The other thing I'd also add is there's a lot more companies that are offering benefits. So for us, for fertility, Walmart just announced this week that they're offering fertility services to all of their employees. So you have large companies that are starting to offer more benefits, which I think is helping to kind of put this inflation within healthcare, at least in perspective, because you still need the care, you still need to see your physician, or you still want to continue to move along with an IVF process. And you're now kind of getting a step in from either your insurance company or your employer.
I think we could look at inflationary uncertainty from two different perspectives. I think the way you broke it down, Dan, makes a lot of sense. On one hand, do my clients, do your portfolio companies need to increase their compensation or benefits to align with inflation? What we've been seeing, every one of our clients have to offer more and more in terms of benefits and compensation, even before we were concerned about inflation, just to stay competitive, to retain folks. It was really competitive just to find some quality. Salaries were going up. I think that we're just continuing to see that the cost of labor is increasing. That's what I think a reason why one of my clients who is offshored the vast majority of their non-clinical employees has so much interest in market right now, because they have a novel approach to sort of counteracting some of these salary increases and staff identification and recruitment pressures. But we are seeing that every one of our clients is seeing that they have to pay more. But again, I don't think that's recent. I think it's just a continued trend. On the second end of that, the question of are patients, are prospective patients willing to pay out of pocket? And you're right, Dan, that with a lot of reimbursed services, third-party reimbursed services, reimbursement is set, and you don't have flexibility to charge more. But when there are out-of-pocket, non-covered services, understandably, there's the question of, are those being impacted? And so far, we're not. Not only are we not seeing volume drop at our clients that offer elective, aesthetic, non-covered services, but we are still seeing very strong interest in those kinds of businesses. We sold a plastic surgery business a few months ago. We have another plastic surgery business in market. There's strong interest. We're also representing a company in the ophthalmology space. And if any of you have looked at that sector, you know that not only is there a very robust commercially and government reimbursed book of business, if you will, but there's a lot of money to be made in non-covered services that are incremental as an adjunct, higher quality intraocular lenses, for example, that a patient may need to pay out of pocket for. We're still seeing a lot of interest in those kinds of businesses from investors. We're still seeing those segments are very strong. I have to imagine that there are going to be segments of healthcare where there might be more of an impact based on inflation. I haven't seen them yet, but intuitively you would assume that there will be some that will suffer. But so far we haven't seen that, and investors still seem to be very interested, even if there is a substantial cash pay component.
So is there? I mean, do we think that there's, if we can remove hospitals and health systems, right? I mean, if you were to read anything recently from that, the kind of the larger scale health system, I mean, it's been a struggle for year-to-date 2022 for a lot of health systems with significant operating losses, not getting any of the COVID-19 funding. I mean, are we seeing any of that might trickle in to any of the healthcare services, or you're still pretty, feeling it's going to continue to be a robust opportunity in the market?
Yeah, we're not really seeing any of that trickling in any of our portfolio companies. And what I think the other thing to kind of keep in mind with those health systems is that, during COVID, there were a lot of services that were normally performed at these hospitals or these health systems that moved and migrated to an at-home service offering. And so, from infusion and from some of these other autism services, et cetera, you're seeing that in a hospital setting that patients are now receiving some of that care at home, and that does have some of an impact on those hospitals and those health systems.
Yeah, we've over the last several years, we've seen this fascinating shift of more and more services that are being pulled out of a hospital, that if they can be provided at an outpatient ASC, then there's sort of step down, can they be provided into an OBL? Now there's several that could services be provided in like a clinic, even in like a strip mall. It's fascinating to see the innovation in various clinical specialties. I think a great one, where we've seen a lot of this, is in vascular care, whether it's vein therapies or treatments to address peripheral arterial disease, where historically, was it maybe 5 years ago, that was all done inside of a hospital. And we've seen this like migration where they can be provided in lower cost venues. Ironically, the inverse of that is that now we're seeing hospital systems try to engage with many of these same companies that historically have taken services out of the hospital and trying to engage those vendors to come and provide those services inside their hospitals. So we're seeing the hospitals try to figure out ways to recover, even if they have to do that in a financial arrangement that isn't necessarily so attractive, but it's to keep that patient flow for other ancillary services that the patient might be able to get within the hospital.
Yeah, Jonathan, that's a good point. I would also add on the behavioral health side of things, we've got 5 assets in behavioral health. Telehealth became a very important component to behavioral health. So that's another area where you're sort of pulling services out of the hospital. And then we also own an inpatient psych business, and we're actually seeing a lot of hospital systems creating joint ventures with our company to kind of provide those services within a joint venture situation where we're managing the entire operation, but they're providing us a space.
Yeah, we have seen a lot more of that services in a health system, but also working with health systems on taking on more risk when it comes to it from the private equity and portfolio company side of the equation as well. So if we see this as a fairly inflation-proof area, and we see more moving out of the hospital sector into this, so what potential constraints are there? What's going to hold it back from growing at its continued rate over the next 12 to 24 months? If there are any, or really there's nothing that's really holding it back other than good investments.
Yeah, I would say that growth is still going to continue to be there because everybody needs to utilize healthcare services. I think from a private equity perspective, from a deal volume perspective, the wild card out there is just interest rates. As we look at those, right now we're not seeing an impact with interest rates. Valuations are still strong. Processes are still very, very competitive. I think long term, if they continue to rise, we're already hearing from some of our lenders that the leverage we were getting isn't necessarily what they can give us now. So I think you're starting to see some of that, but there's still a bunch of capital that private equity firms are looking to deploy. And I think that quality assets are still going to require us to sharpen our pencils and put forth a good quality valuation.
Yeah, I think that we're still hearing substantial interest from private equity groups that have to deploy capital. They have the assets, they need to put them to work. but it's going to be tricky if they can't put as much leverage onto a transaction, or if the interest rates are higher. I think it's going to be really interesting. I think, going back to one of the earlier questions, Chad, that you asked us, I think that there are going to be certain sectors where some funds are going to say, we're out, where maybe they would have put a lot of work in and bid aggressively for a business in a certain sector, that they might say, we're not going to be as bullish on this space. But there still are so many high quality private equity firms that have so much money to spend that there's still going to be transactions and companies that can be financed and can grow. But we're going to see that in some instances, the terms that they used to get to help finance their deal may not be as attractive. So it's a complex formula. I don't think that the interest rates, I don't think that lending capacity is going to shut down transaction activity, because there's so much money still to spend. I do think it's going to encourage some people to pull out of certain processes and focus their time and efforts in other areas.
Chad, if your question was a bit operational, I mean, one thing that came to mind was, obviously we are all living now with COVID, even 2.5 years into it, as in we know of people that have had it, maybe people on this panel have had it. And I do feel if there's any major spike, so far I think they've been sort of widespread but more moderate in terms of severity. But if there's some mutation where it did come back in more severe fashion, hopefully we never come back to some of the shutdowns of Q2, Q3. But yeah, I mean, that could be something totally somewhat exogenous, right, to what we're talking about here, where some of the more retail facing, like we have an orthopedic surgery business in the Midwest that for a couple of months in 2020 was effectively shut. And other physician practice businesses as well went through that. So that's obviously a exogenous variable. For our mostly asset light businesses and generally selling services as opposed to products, I think the supply chain has not been an issue, but let's acknowledge that there certainly are parts of healthcare where the supply chain is a bigger variable, and it's been coming back. And I think we have one portfolio company where we're seeing it sort of firsthand, but again, it's not at all where it was before COVID. So there's some operational, if you will, elements to growth that are still not where they used to be. So that's somewhat of a constraint to your question. But from a investor interest standpoint, even the ability to finance, I mean, that those elements will probably be pretty accommodating. It's just the company sort of figuring out. And then the other thing is, again, we do feel, or I certainly feel, that a softening or a recession will be not a capital R, probably a smaller recession, hopefully. But if that does look different, if the Fed doesn't get it right, I mean, we know healthcare is resilient, but it still would be something where growth rates would need to be adjusted. And that's probably where I know one of the sort of participants had a question about parts of healthcare that will be more attractive versus last. I mean, we can tick through some areas, but I think you will see a little bit more of a sort of tranching, if you will, some areas that are more resilient to that versus others. So yeah, I think it's a mixed, I think as Jonathan just said, a mixed complex equation to determine exactly what will happen sort of in the next 12 to 24 months. But I think we're all generally optimistic on this panel, I guess, is the common theme.
So I know we mentioned that you have not seen a ton. What do you think's keeping, is it just the dry powder out there that's keeping the valuations kind of where they are, as opposed to getting those tempering down? Because we are seeing that in other industries where you're seeing them start to move down a little bit from a valuation, but healthcare, it sounds like from this group, it's still holding where they were from a valuation perspective.
Well, Chad, I think it depends on the sector, right? And we've seen this for years, that every little niche within healthcare seems to run in cycles, where there might be a great industry niche that Dan or Vlad discover where there haven't been any platforms before, and they bring their full team in and they identify this great platform that has the potential to take over the country, and they can acquire it if they're the first mover at a relatively low valuation. And then they can start tucking in other smaller assets at a diminished value. But as other investors start rushing into that sector, we see this copycat concept, understandable, You can find a great sector, make a lot of money on it, other people start, and that pushes the value up within that little niche. And I think most of the people on the call know this, that as people start rushing in and the highest quality tuck-in assets are no longer available at 6 times, 5 times EBITDA, now when you have to start paying 10 times for a tuck-in, then the sector starts to struggle to yield the returns that maybe it would. And we've seen several sectors where the biggest consolidators are bloated with a lot of debt. They can't meet their payments. You start to see certain sector niches where you have certain big high-profile failures, and the valuations start to fall. The valuations reset, right? We've seen this in several sectors. I'm going to throw one out: radiation oncology, right? Where there was this fascinating wave. A lot of people made a lot of money. Then some of the biggest platforms really struggled. The valuations went down. But look at diagnostic imaging, where a few years ago, the valuations were at a really bad spot. But take it back. Let's even go back 10 years ago. Radiology was down, went up, fell down. Now radiology is moving back up again. Now, depending on which little niche you are, professional or technical, there's some very attractive valuation parameters for sellers right now in diagnostic imaging. So again, as an industry, we're not seeing that it's just coming down, but within certain niches, depending on where they are in that cycle, they could still have really attractive valuations, or they could have pretty deep value opportunities if somebody wants to look at them.
Yeah, I think we, given where most of us on the call spend time as far as stage of company, that's the other area, chat, where you could see variability in addition to the end markets. I think companies that are grabbing the headlines 6 months ago with $1 billion plus or even hundreds of millions dollar valuation, but limited revenue, I mean, those valuations are no longer there, right? So that's probably where you've seen the most immediate sort of drop or disconnect, if you will, between what it was prior versus what it's today. But for a stable cash flowing business, even if the growth prospects, I think, are somewhat adjusted to Jonathan's point, if it's going through some cycle, and those are valuations that kind of dial up and down within some band. But I think the ones that definitely just in a very different conversation altogether were those that are, again, maybe it's and those skew a little bit more health tech. Where exciting sort of business, but perhaps raised money at a valuation that is really ahead of where the fundamentals of the business are. And those have come back now in Q3 to maybe raise more money, either smaller rounds. We've seen some of those just because we track some of these for just general information. So I think if they wanted to raise, say, 50, now they say we only want to raise 20 to 25, maybe get us through the next 6 to 12 months, and then go out for a bigger round with maybe better macro, better sort of health tech sort of valuation. So I think it still fits in Jonathan's comment area as far as sort of some cyclicality within each end market, but also you got to keep in mind stage of the business, where for sort of where we spend time, I think on this call, it's just been a bit more of the same.
Yeah, I would also add, it depends on also where it is in terms of the horizon within healthcare services of where's the consolidation. Are there 5 key private equity backed portfolio companies that are kind of taking most activity, because you're going to see competition there. If it's a newer segment, you're going to obviously see valuations a little low, but those are all relative, because even for some of those new companies, because there's so much information out there about what the multiples are for these businesses, shareholders are knowledgeable about what the valuation should be. So we're not talking about a 5 or 6 times business on some of these. It's going to still be a pretty good valuation. To note on the other areas where we're seeing sort of a lot of interest within healthcare services is this value-based care model. So moving away from the fee-for-service model to the value-based care, we're seeing a lot more activity there, and we're seeing a lot more interest, not only from ourselves, but other private equity firms in that model, because you can leverage that model not only in primary care, which has kind of become the main value-based care model, but these other facets. So that's an area that I think one of the questions that we saw come in was that's an area to look at, because value-based care is not going anywhere. If anything, it's going to expand more than it currently is. and it'll be interesting to see how that works out.
Yeah, talk about cycles. It wasn't that long ago where primary care was a sector that had one of the lower multiples in all of healthcare. And now as more and more groups are adopting more risk-bearing relationships with their underlying payers, to see that value-based primary care is one of the hottest sectors in all of healthcare, with some of the highest multiples on EBITDA, with tremendous returns for investors. It's fascinating to see the growth opportunity when companies understand how to take risk. I had a chance to chat with a very well-known risk-bearing entity out here in California, the Heritage Provider Network, and I know the COO, Jonathan Gluck, and his favorite saying is, these days, risk is a lot less risky. And what he means by that is, obviously, that if you understand how to play that value-based care game, if you can participate in a system where you can get that pool of cash to allow for compensating your providers, but that you can actually manage the populations that you serve and to be able to lead them towards better outcomes, you can make a lot of money and improve the overall health for your population. There's lots of people who've been successful in it.
So as we're on the topic of value-based care, I mean, are we seeing there, do we think there'll be more interest in taking on what I would consider full risk, both up and downside?
Yeah, you definitely will see that. And during COVID, the model was interesting because a lot of these services weren't being used. So, because people weren't going for regular visits and things like that, but you're definitely going to see a lot more activity there. You're going to see providers looking to take on that risk, because at the end of the year what per patient what you're getting, and you can basically manage your whole system that way. You can provide the services that they need on a proactive basis rather than reactive.
Yeah, in a lot of the and there's a question that came up on this that kind of leads into it. So how do we interplay? Because usually it's managed care that kind of brings those contracts, whether it be Medicare Advantage or Medicaid managed care, are the ones that I've seen and have clients that have contracted with. So what's the interplay with some of the other services like senior care as well as ambulatory or ambulances as well? How does that interplay into the model, or do we think it's strictly going to be a primary care focused model and there's not going to be a lot of interplay with other sectors within the healthcare?
I think there will be. I can take a stab. We don't have a existing portfolio in this particular sort of, if you will, theme, but have looked at it for so many years. And it's one of those where it's always been here, but nobody can really describe it. Yeah, we primary care is the lens we're looking through for this value-based care, just general opportunity chat. But if you think about sort of what's around it and supporting the overall sort of delivery of care, you got to bring into your point ambulatory and other services. We're talking now with a group of physicians in the Northeast that has been doing shared savings for a number of years and has been very successful at that. They're looking to bring on a capital partner to basically allow them to move to full capitation and global risk. So they're building an ASC, they're working with just in-home as well. So I think it's really all about managing the total patient sort of well-being, for lack of a better word. And then the other thing from the perspective of somebody like a Martis or Webster, it's a little bit of where your comfort zones are. Some people are obviously a little bit more risk tolerant. Even though Jonathan said risk is less risky these days, there's still plenty of risk out there. It's just how are you wired? And we'll talk about it, I think, in a couple of minutes, but about the LP perspective, committing to funds like Webster or Martis, because our mandates are probably relatively sort of this type of risk as opposed to this type of risk. So I think value-based care is a great opportunity. It's just you have to have experienced operators that have done already some of the early work to demonstrate they're able to do that switch from fee-for-service to value-based. Or if you don't want to back somebody that's already done it, you just will be taking more risk to do that switch and maybe getting slightly better valuation on the way in. Yeah, I'd be curious on that, Dan, if you've looked at something or maybe even have something in the portfolio where that was on the continuum of fee-for-service versus already doing a little bit of sort of value-based care.
Yeah, so we don't do a lot in the skilled nursing, but we do have a business that does physiatry into skilled nursing facilities. And so for that business, I mean, we are going to see that we're probably going to end up taking more risk depending on that patient population. But I think you'll see it over other sectors within healthcare. It's not going to be, a flip of the switch overnight, but gradually, as you start getting more providers and more facilities into this value-based care model, it's just going to become kind of the norm. Also, you're going to see some states are going to move faster than others. So some markets, you're going to see that happen quicker. Some insurance companies are going to want to move that faster too. It's just an area I think that we're going that is going to be positive for everyone once people get comfortable with the risk.
So I know we had talked about it last week a little bit on looking at the impact on fund subscription. Obviously, it's a question more for Dan and Vladimir when we look at it. I mean, are we seeing, kind of going back to the topic that Jonathan, if there's certain sectors, are we seeing the funds staying broad, or are you seeing potentially that funds are getting more narrowly focused in what the subscribers want to see in that fund and what they want to see you go after?
Dan, go ahead.
Yeah, so we just actually closed fundraising about a month ago for our $1.7 million fund. And I'd say that we previously were focused on branded consumer and healthcare services. And the messaging we got from a lot of our LPs was, if you have a single focused fund, we know where our money's going. We know exactly the sectors that you're focused on. You have more defined theses in terms of developing those theses and then going out and finding those assets. So we had a great fundraise, and it's all healthcare services focused. I'll also say right now the market is kind of choppy for fundraising, and it took us a little longer to get our fund closed than we probably had expected. And we're hearing from our peers that there's capital out there, but LPs are a little bit more methodical. They're taking a little bit more time. They're doing more due diligence just because of where we are in this broader cycle. And so I think you're going to still see LPs that are going to be attracted to single focused funds. You're going to still see money that those LPs are going to want to put to work. It's just going to take a little bit more time, I think, to educate them on where you're looking to deploy capital, but also just in the broader economy and the market where things are.
Yeah, we're just a little bit behind where Dan is, and congrats, by the way. It's a great outcome for the team, and we obviously in the broader space, but it's a big healthcare world, and we respect and support our other sort of peers. So congrats. Yeah, I'd say we've always done healthcare and only healthcare, but I'd say people are very curious. What are your themes? That's the level of detail. Even I'm sure for Dan, when you say services, people are like, well, tell me a little bit about where, because it's such a big world. So we've been getting a fair bit of those questions. I think the last 3-4 months or so, a little bit of a pivot where people are now a bit more mindful of, where is the sector, how is the sector positioned in the overall macro? And I think healthcare is, as we talked about today, is favorably positioned. So that's a clear plus. But then there's more aspects around things that really outside our direct control, as Dan referenced, the choppy market, where sort of the Russia-Ukraine conflict, just overall global economy, still some COVID out there. So, and then the whole element of funds coming back to market more rapidly in the last few years, where the existing LPs are asked to re-up much sooner than they would expect. So there's a little bit of that imbalance, the public markets being down as they have, so causing a little bit of a denominator effect. So there's many variables here, and we want to be sort of focused for the conversation today. But I'd say for anybody raising funds today, and Ampersand just announced oversubscribed fund, Riverglade, just in the last couple of days. So I think you have to look back at the fundamentals of team, strategy, track record, and sort of being consistent across these and showing just reasonable repeatability of what you've done before, that you can do it again. I mean, that's sort of what really investors would look for. So I think what Dan and I do a lot on the BD side is making sure we can replicate those successes from a sourcing standpoint and just connecting entrepreneurs and obviously working with Jonathan's group as well now at BGL. But yeah, I think on a comparative basis, I think healthcare funds will do well even in this environment raising capital. It just will be more drawn out, and perhaps people have to go a little bit further and wider, maybe go overseas as we have done, sort of planting a flag in Europe to diversify the LP base. So hopefully that was helpful, Chad. I know you kind of left a little bit open-ended, so apologies.
Yeah, and I agree. So from the perspective of if your fund has generally been US-based LPs, what we saw in our recent fundraise, and we went from 875 million to 1.7, was that we had to expand the geographies of where those pockets of capital were going to come from. And so healthcare is very strong. I mean, people are investing in healthcare all over the world, but a lot of the pockets that we have in this newer fund are outside of the United States, which is a little bit different for us than historically maybe what we had seen in the prior funds. The other important component too is consumer health, and we're seeing a lot more in the consumer health space and people wanting to see how do you connect the end consumer with the healthcare that they're receiving. Some of that's technology, some of that's products, but by and large, that's going to be a service component. So I think that's another area where you're going to see a lot more activity is how do you connect the patient with the provider and make it seamless for them to be able to be treated for whatever issue they're having, or just monitor their health as they continue to go about their lives.
We have a handful of minutes left here before the end. I know I think we touched on a little bit of all the questions. I do want to circle back on one of them related to loan volume. I think, so do we think that even if the large funding sources are pulling back on loan volume, that's being effectively offset by the amount of dry powder that's out there at the end of the day? Is that what's offsetting that? And that's something that may be more impactful a year down the road if we're taking longer to get a fund fully subscribed, where debt would have to be the other option to get an acquisition done if it's not getting all the way subscribed.
I know Jonathan has some, I'm sure, and Dan some thoughts. I was going to say, as we mentioned last week, even before this explicit question, I think depending on what tab you are in and how much quantum of debt you need, I think the smaller overall it is, the easier, I think. So this comment may be just a little bit more to the higher end of the market, but you're right. It's obviously, that's where you'd see it first kick in, the pullback in terms of volume. So it's a direct relationship with M&A activity. There's no doubt about it. I mean, people can only equitize it as much until the returns don't make sense anymore. So, but I don't know if anything more sort of insightful from Jonathan or Dan.
Yeah, I would say I think volume is going to be down, but one thing more big picture economy, larger commercial banks are very, very cyclical in their lending. So as the market slowed, we knew that they were going to start slowing down a little bit, just because that's what they've always done. And so I think where you're going to normally see, Bank of America, Wells Fargo, et cetera, where they're active in some of our processes, you're going to see a lot more of the BDC stepping in. You're going to see maybe those larger commercial banks giving us, maybe a turn or a turn and a half less, but then we're going to have to go out and get other capital from other sources. I still think you're going to see, because the healthcare market is so robust, you're still going to see volume within lending. It just may be a little bit more expensive, and it may not be from your traditional lender that you've used for your last 10 deals. But I think that that's an opportunity where you can then refinance out as the market becomes a little bit more stable in terms of debt.
I'd say stay tuned is all I can say. So far, we haven't seen a major change in the transactions that we're working on. The buyers have been able to finance their transactions. We just got a very attractive leverage read from a lender on a transaction, a physician group transaction that we have in market right now. So far, it looks like it's full speed ahead. But I think that everything that Plante and Dan were sharing is something we all have to be very focused on in the months ahead.
as we kind of near the end here, so kind of going back to one of the points we had discussed last week is, there is cost increases overall in healthcare. So are there opportunities with what's likely going to be consolidation in the market? Are there going to be, is there going to be all of the opportunities at the lower to middle, or some of that going to continue to creep up as cost becomes more inhibited as you get to the middle and upper market?
So are you asking more on the reimbursement side of things, or just in general?
Just in general terms. Yeah, as costs go up, it's going to be, whether it actually happens or not, where consolidation actually decreased costs is still, I think I can go back to economics class on that one.
Consolidation is always an option. I think the other options are you start to offer services that maybe are not in person, more telephonically, or remote services. Something that may be performed in a facility might be performed at home. Costs go up. And I think COVID showed us that innovation came when we needed to find a way to innovate in healthcare. And so I think that you're going to see that happening more and more and more. And the costs are going to, inevitably go up at some level. It's just a matter of adapting to be able to make sure that, reimbursement is kind of sort of in line with that, and then offering the services at the lowest cost of delivery that you can provide.
I agree. I mean, don't have much to add, but
Okay.
I think something to keep in mind is there's this increasing regulatory scrutiny, especially out here in California, about consolidation. And is it simply to be able to command better pricing negotiation? Is it to be able to extract costs out of redundancy? I think that it's important that as we look at consolidating assets across the healthcare industry, that those combined forces allow for greater access, greater quality, greater outcomes. I think that's going to become, a more important area of focus as larger and larger healthcare organizations are brought together.
All right. Well, 1 minute left. Any closing thoughts from the group?
I mean, look forward to, frankly, I think we're right now, if this webinar was in December, I think some of our comments would probably be different. We're kind of in a information shadow right now, where Q2, early Q3 metrics, we're kind of working a little bit anecdotally, I think, today. Obviously, we're in the market real time every day, but it would be good to see the actual sort of broader statistic get printed, because right now we have individual data points. So it would be great to see the broader market. That's, from my standpoint, will be interesting for the balance of the year to see how it actually plays out.
Yeah, I agree. I think we're still early on in this. I don't think that everything is sort of caught up with where we are in the cycle. And so I think if you look at December, January, even maybe a year from now, it may be a completely different story.
Yeah, I think that's some of it too. I think we're still in the short-term memory of a year ago when it was an extremely active market. But looking anecdotally, if we look at what we've seen from some of the sell side QOVs that we've done, it appears that Q4 should anecdotally, pick the pace back up again. But we will see where that lands.
Yeah.
All right, 12:30 or 12:30 Eastern, I'll say. But appreciate everyone's open conversation there. It was
gentlemen,
good
I want to thank you. Thank you for that discussion. I think it was pretty insightful, and maybe we'll circle back in December and do another one and see where we stand then. Thank you to our panelists, Chad, for leading the discussion, and all of you for participating. To our audience, thank you. Special shout out again to Chad and Plante Moran for sponsoring this event and our Healthcare Deal Connect. If you are participating in that event, you're going to want to sign out of here and log into the separate link that we circulated yesterday. I do want to highlight a couple upcoming events, specifically the two in New York in September on the 7th and the 8th. We're doing a debt summit. It's going to start off with one-on-one meetings between private lenders and debt-raised investment bankers. And then we're going to transition into 3 afternoon panels focused on the lending sector. So it's going to be probably one of our biggest events of the year. It's in person in New York City. If you're interested in getting involved, reach out. And then, of course, our fund summit the following day between general partners and limited partners should be a couple exciting events back to back there. Again, thank you all so much. Everyone stay safe and healthy and sane as possible. And we look forward to seeing you all soon. Thanks again.
Thanks, Nina. Thanks, everybody.
Thank you.
Take care.
Thanks, everyone.
Bye.